Sorry about that. Mute button. Anyway, I was saying, welcome to the last MT Live of 2021. 1 second, please. So we did lots of MT Lives, and I think they were all great. Some maybe a little better than others that maybe hit the mark for you and what you were looking for. But what Dan and I do each week is pick a particular topic based on MTS, whether it's trading options or stocks or ETFs. We haven't done too much on futures, but the patterns are all the same. There are some nuances. But this week, we thought we'd take your questions and answer them as to whatever you might want to talk about. And we know that always helps others, to listen to what other people are struggling with or want cleared up with a particular concept. And of course, if you have any question of your own, we invite you to throw them out there. It makes it more interesting for us to, banter back and forth and cover a few things to help going into the new year. So that being said, Dan, let's do it.
All right, sounds great. Welcome everybody and happy new year in advance. Yeah, so Greg, you maybe can help me with these, we always have some slides for new people, just show you our approach of, how quick you want to go through these. And we did get a few questions sent in by email. But yeah, we'll just keep it informal here. We're here to help you answer anything you want. So if you want to start asking questions, I'll just interrupt the slides. Otherwise, we can spend a few minutes with our approach as we always do. So what is our approach? You need, Greg, we both have so many stories, but you tell the one about, well, tell them the one about your course. And if you want to learn how to play basketball or be a mechanic or be a doctor, that's what this first one is talking about. You need an approach. You say, I want to learn to trade and invest and manage my own account and succeed objectively. How do you answer that?
Well, you need a plan like anything else. How do you do any profession, any job?
Right.
It has to be some type of template, if you will, as to how you approach things. So you start out with some basic template and the fundamentals of whatever it might be. And, doctor, lawyer, Indian chief, whatever it is. And, you start with that. So with trading, when you say, well, it's either fundamental or it's technical. I can't tell you about the fundamental part. While I studied it, it just didn't hit it for me. Too many variables, too many institutions, and we found out after the fact, lying about numbers and so on. And in the moment, the most unfundamental company can perform fabulously well and vice versa. So the charts are how we approach things, which moves to, is it going up, down, or sideways? What stops it from going up, down, or sideways? What causes it to accelerate in one direction or another? How do I get on board a particular trade once I recognize that it's going up, down, or sideways? How do I manage that trade once I do that? How much money do I deploy to that particular trade? And so on. And so all of these questions, and there are others. How does this particular stock or this market perform relative to another market or another stock or a sector? And so the course, right, that Dan is referring to answers those questions. In addition to, one of the biggest subject is, well, trader psychology. Why is trader psychology such a big deal? And the reason is that trading, unlike other professions, you never know for sure. Meaning everything could be lining up and there's no guarantee that if I do A, it will result in B. So psychologically, it is difficult because human nature wants certainty, and trading doesn't provide ultimate certainty. And so in addition, as we get deeper and deeper into this, Dan, it goes into other subjects in that,
Absolutely.
people associate this with gambling. In reality, it's not gambling. To some it is, but you go to the casino and play blackjack or roulette. At some point, the dealer says, "We'll stop. Cards are done. Takes your money." Doesn't work that way here. It's like you can stop because the broker shuts down your account. There's no money left. But as long as you have money, things are moving, and it's up to you to say, "Nope, that's it. I'm willing, that's where I'm going to take my money. This is where I'm, going to, stop whatever losses may be." And so that psychological part of the unknown, just plays havoc with the mentality of, is this really a place I should stop out? Is this really the place I should take my money? And so it evolves into a trading plan that includes money management that you eventually grow into, that this is what I do and how I operate, because long-term, it's the only way to survive.
And then the patience, right? So all that was wonderful. I'll kind of just summarize it in one sentence. You need an approach. You need an objective, systematic approach that works, which ours does, your course. Then you need seasoning, and that's it. And the patience and discipline to follow your approach. That's it. These are some key concepts. So Greg, the one slide we show all the concepts, I kind of broke them out here. So price is king. This is what we trade. We trade patterns. This is a graphic representation. It's the most transparent, easily grasped, and we say that charts don't lie because these candlesticks of anything you're trading on any time frame are reflecting the supply and demand relationship in that time period. Case closed. And that's what we're trading. So the media can lie, earnings reports can lie. Greg said greed and fear overshoots fundamental truth. And this is just a shortcut to what works. So where are these pictures in the trend in multiple time frames? Look to the left, support and resistance. Greg, I got this little guy for you. McFly, look to the left.
You make me laugh. We joke about this McFly thing
because it's a great movie.
It is, but there's a better picture from the movie where he's like banging on his head.
Okay, I send it to me.
Yeah. So for those that aren't aware, it's from the movie. What was it?
Fast Times at Ridgemont High.
No. It was going Back to the Future.
You're right. But so that was a different quote I was thinking of. All right, Back to the Future. McFly. Yeah.
It was like, hey, this guy's kind of dumb, and wake up there, McFly.
Right,
so the whole thing about this is like, hey, McFly, you need a trading plan. You need this. You need that.
All right. So here's some more key concepts, moving averages, visual aid, volume, position, money management. This is, Greg, your beautiful quote. Patterns are a picture of psychology and motion. I mean, that's powerful. Fueled by money. You're putting your money on the line of where you have a bias based on whatever reason.
Right. Yeah, because when we start looking at charts, when we're starting out, it's about, what is a candlestick? And these candlestick names, which really are irrelevant, but worth, I guess, just an initial education as to these names. But in reality, that's unnecessary. It's about understanding candlesticks through retracements, and that's another empty lie. But in the end, your own emotional things that are going through your head and feelings when things are going well and when they're not. And, again, I like to share our own experiences with this, but and this one is, in retrospect, talking about it is kind of funny. In the moments, it wasn't funny, But, it was like, how the hell am I selling the low of the move? It's like, there must be something to it. If I'm picking a point to sell the bottom, there must be a picture related to that event. And it's like, hey, as you start thinking about feelings and emotions and what people are doing and what those pictures are displaying on the chart, it was a wide range bar. It's like things are going down and we're in pain. And it's like, I know it's going to turn around. It'll turn around. And it's like the ultimate certainty point is where you press that button and you're 100% certain it's not going to turn around. So how the hell did it turn around when I sold? There was a picture. There's a picture for that. And there are different pictures. And this is where bar by bar, the concept of bar by bar evolved from. It's like, well, if this picture means something and this picture and this bar means something, how these different bars or pictures in relation to what happened in the past allow me to continuously update information in the timeframes that I'm using. So, this idea of patterns or a picture of psychology in motion fueled by money just really brings charts to life.
Greg, one quick story, and we really, I think that's move on a little bit. But when I was trading with you in New York 22 years ago, this guy, Rick, was holding a losing position for 10, 11, 12 days straight. I forget what it was. He was over there, bellied over every day. And you came to me and you said, Dan, tell me when he sells it. That'll be the low. And I didn't know what that meant at the time. And that's exactly what you're talking about.
Okay.
So you take Greg's course, you have an objective approach. Now, that's going to give you the confidence, patience, and discipline. That's a whole nother discussion of this is the course and mastering the course. So you have to, subjective analysis must be reduced. The course does that. It gives you a systematic approach. And then over time, it's going to build confidence. You know how often, Greg, you and I in the trading room, we're sitting there, it's like, I don't see anything. I don't see anything. It's because we have a trading plan and we have confidence, and so maybe you can add a comment on this. I don't know why. Patience and discipline was kind of innate in me. So we're out there hunting and you're in a deer stand and you have an approach to shoot a deer. You don't just sit in the deer stand shooting in the forest. You got to have patience and discipline to wait for your setup. And so, we say in the trading room that, the odds are horrible. It's not, I say analogies like it's not my strike zone. It's not my setup. So I just pass. So that this comes over time.
Right. You're sitting there, and one of the things that you learn over time is that there are times to just sit back and nothing's going on, but that doesn't mean to become complacent. And we often do because, hey, there's nothing happening. And this is where the idea of reversal times come into play. And we know a bunch of stuff from reversal times, meaning first thing in the morning is where it's best to be most active if you have a setup. Everyone else is most active, so things are moving around. If nothing's happened in the morning, things have a pretty good tendency to happen between 11:30 and 12:30, 1 o'clock. It's kind of the way it plays out. If the morning played out the way it should, where things are active, lunchtime becomes what we call the doldrums. And then around 2:15, things start to pick up again. And, you start getting ready. There are certain trade setups that occur around 2:15. And many things then begin to get active again, 3 o'clock and 3:30. So those general guidelines say, hey, pay attention here. If this happens, you can relax a little bit. If that didn't happen, maybe it's not a good day to go to lunch. And if you're expecting doldrums to be okay, doldrums, well, hey, you got to come back from the doldrums and start paying attention and seeing what your interest list is doing, or maybe new scams.
Most folks who know us know, we don't look at oscillators because that's just a derivative of price. People draw lines. Whoops, wrong way. This is what we look at. Very simple red and green candlesticks. We have different moving averages on each chart, color-coded volume. Everything else is our concepts of patterns, of trend, of support and resistance, retracement, red and green bars ignored. So that's what we teach, and then things jump out at you. So these are just concepts that every time Greg and I look at a chart, our eye just automatically will gravitate towards compelling setups. So can you see a buy setup in here anywhere? Can you see a W retest? Can you see a wide range breakout? Can you see a bullish 1, 2, 3 continuation? Here's my W. I mean, look at that beautiful gap negated 1, 2, 3. Here's my buy setup with a 180 reversal. This was a wide range breakout also. And that's the seasoning part. Everything I just said is in the course, is in Greg's course. And then it just takes time to put it together. We can see what's going on larger time frames with these 3 moving averages, the 20, 50, 200. Trading plan, we've kind of already covered this. This is the plan of how you're going to conduct your business. What patterns are you going to trade? What position size? What instruments? What time frames? How are you going to get continuing educations, et cetera, et cetera. So this is what we're going to do now. So let's move over to look at real charts. This is open. We'll give us your best idea. Open. We'll just any question you want. We can scan the markets, and these are concepts that we're always going to be talking about. Our holiday deals they go through the end of the year. These are the best prices for all of our offerings. The advisory letters, the live trading room, the courses, mastertrader.com / you got to spell it properly. HOLA, HOLI deals. There you go. Thanks. But check it out. Email us with any questions, and we're not leaving you till 1 p.m. But last show of the year. Hope everybody has a fantastic new year. Trading and otherwise. If we miss you, if you sneak out early.
No one's going to sneak out early. There's a ticket for that.
Yeah, as Greg's switching over, I'll start with some questions right here that I see.
I got them all.
All right, cool.
Put to the side here. All right. Oh, one is, if my main time frame is the daily, when do I drill down to a lower time frame, and how far time frame do I drill down to? 60, 15, 5. Once I make an entry, do I go back to the daily time frame to manage? When do I look at the weekly? Wow, that's a module in a course. But so if you're trading from the daily time frame, which means you're swing trading, I can tell you right now, forget the 15-minute, the 5-minute, the 2-minute, the 1 minute, and so on. The hourly time frame can be helpful, but going down to lower time frames, if you're swing trading, is a deterrent to profiting from the time frame you're trying to trade. See, as you look at smaller time frames, you'll see more information, but that information may be irrelevant, and it's going to influence your thinking. So watching these micro retracements on a 5-minute time frame, it's going to play havoc with the strategy from the swing setup. So managing based on support and resistance on this daily time frame. The weekly time frame can be your time frame to guide your bias or help that. And so using the hourly, to drill down on an entry, so possibly, you got a wide range bar on the daily and you're looking for a little consolidation pattern on the hourly, and then go back to managing. But money management, you have to manage the money from the daily time frame, meaning you're going to share size it to where you've determined your stop loss is, and then share size accordingly. Because if you don't do that and you don't share size it, and then some little micro move happens, and now it's like the loss, that I can't accept that loss. Of course, you're going to, become confused and maybe do things that you shouldn't. So money management is a big key. And believe it or not, the majorities look at money management, the last thing, as a desperation to make money, which is totally ridiculous. But we kind of force feeding you the money management part with these holiday deals with some of the courses, where you're going to get the money management course free, which probably in reality, it should be the most expensive course that you should pay up for and, take first, but most don't. So part of the deals is a 2-for-1 where you can get that for free. All right. Now the question was, really appreciate that you provide the stop losses on our trades, but how do we calculate the stops of our trades? We take a trade on our own. Well, if you took the course, you'd know how to do that, but is it a percentage of loss or what? Is it a different calculation for spreads, credit spreads, put spreads? I'll let you take that one, Dan.
I'm sorry, I was busy typing. Can you say it again?
Really appreciate you provide stop losses for our trades, which relates to the letters where we always give a stop loss. But how do we calculate stops for our trades we take on our own? Is it a percentage of loss or what?
Yeah.
Different for spreads.
No, it's not different. And the quick and easy way is just to pull up a risk graph and see where your stop loss is. And then that will show you an estimated amount that your spread would be at to close it. And then you take the difference and that's your loss. I also, in resources, our very last document in resources, has an extensive discussion on managing risk on selling options, which includes 3 different videos, one on setting contingent stop orders, one on exactly this subject of calculating your max loss. And I show you how you can, swag the number. And so very simply, let's say you're doing a credit spread, a short credit spread on the spiders, and your stop is $5 below. Well, take the current price of the spiders and go up $5, against you and see what the credit is. And this is all explained in that video. But it's nothing's going to be accurate because options move with the Greeks, which is time, volatility, and the underlying move, the directional.
Again, hold on a second. I know you have a better explanation than nothing is going to be accurate, meaning nothing's going to be
you don't like the truth?
accurate like it would be to say, hey, like with the chart that is right here, if I was to say, you know what, I'm going to short this stock and I'm going to put a stop up here,
Right.
and I'm gonna share size it accordingly. And if it trades above there, based on that share size, I'm going to lose that exact calculated amount less any slippage that might occur.
If you trade stocks, you can have a certain number. If you're trading options, you cannot. And so the truth hurts.
Well,
but I told you how to, I just gave a lengthy answer of how to give the best guess. Like today, for example, Tesla was up against us. We were short a call spread, and I told detective, I said, you know what? Regardless of this gap against us, it's not going to hurt us because of the overnight time decay.
Yeah.
You can't see that in a risk graph.
Right. So you're the option expert and you know all of this stuff like the back of your hand, but sometimes someone like myself that kind of looks at things in a more, I don't know, broader sense, in that I understand what you're saying. And it's that with options, you have this time issue that plays, I wouldn't say havoc, but moves the prices around based on time deterioration.
The closer to expiration, correct? Not 40 days out. It won't move that fast.
So when you have more time, that has less of an effect.
Correct.
The other part is the same movement that with an option, you have prices are moving, and it could move like this, or it could do this. Now it's at the same spot, but with options, because the price moved fast, now that calculation becomes something that's not accurate as you thought it might be. So there's speed of movement and there's time that come into play.
And volatility, right?
Right. So, how you calculate that, it's kind of like a moving target, and that's what makes it more difficult.
Right. It's a Black-Scholes model. It's a computer calculating it.
Yeah. All right. So we got more questions, and I don't want to.
I know. Yeah. Keep going.
Yeah. So on credit spreads, how do you determine the width of the spread and the premium limit?
Yeah, I spent a long time typing that answer, but in a one sentence, my default is $5 to $10 wide, but I'll go smaller or bigger based upon the price of the stock and how much of that net credit am I trying to keep based on my bias on the charts.
Yeah. And well, that is the general thing, $5 to $10 wide. We've been doing things on these high beta stocks with expiration within 0 to a day or two. And because it's so close and there's so much premium away, that we've been doing stuff $50 wide.
Right. And we did it. I typed that we did it on Amazon and Google, $50 wide for Friday.
Right. I think we've done it on Tesla.
Yeah, Tesla, we have a $20 wide open. So you might say, well, why the heck you pick 20 on Tesla and 50 on this? And part of it is, we teach in the course, and part of it's seasoning, but I'm looking at the quotes and I'm like, all right, and I look at the pattern and I see how much of that net premium that I'm keeping for the width. Because if you have a disaster gap against you, then that's going to be the wider the spread, the bigger the loss. So everything is the max gain, max loss based on the pattern and the credit received.
Everybody, one of the advantages of the green room, besides trading ideas, is the ability to come in there and pick our brains. So, I mean, it could be in the afternoon and nothing's happening, and Dan could give an explanation of what we're talking about here over the period of 30, 40 minutes.
Exactly. That,
you get the back and forth. It's like, oh, I get that. Or Dan, what about, this point? Can you explain that a little bit more? And, that's a great point. All right. In YouTube, Mr. or Mrs. Fat Fingers. Oh, it's about Back to the Future, but he also said, Dan, how do you handle stop loss orders on credit spreads in regard to spread slippage?
Well, number one, that's why you always need to trade liquid stocks, liquid options. Now, the top 10 are Spiders, Qs, AMD, Facebook, Apple, Microsoft. Those are all liquid as can be, and I don't mind the market out on those. Everything else I recommend, I use Thinkorswim, and so whenever I just click the trade and say load it up to close it, it always puts in the midpoint. And so I start at the midpoint, and then you have to adjust it penny by penny or if it's a wider stop, nickel by nickel, until you're filled. I mean, that's the only way to get the best out.
All right. Here's one. Ethel said, how do you profit from V patterns? You buy the bottom of the V and you sell it as it goes up. But I don't like V patterns. And this market has been one in which that it does produce V patterns. There's been some wild kind of price patterns this year, but this is a kind of a V pattern right here. But let me get a little pointer out here.
Well, Ethel, it's the same. We'd be selling a credit spread over the top of a climactic sell setup, bottom of a climactic buy setup, and manage with the charts. So it's
yeah, credit spreads are much better for V patterns than directional trades, because with a V, it may not move. It may not just pop up like that. They don't all do that. Some of them, they just go sideways. They chop around. So with credit spreads, you just say, hey, and they're actually great for V patterns, because part of a V pattern, what we're looking for is a nasty climactic drop or an advance.
Well, and to add to that, volatility is going to be expanding on the greeds, on the fear side, collapsing. I mean, that's a no-brainer. Volatility is going to go up, puts are going to get more juicy to short. But volatility is also moving up on the greed side. Do you remember Tesla? Do you remember months ago, before they were doing a stock split or getting added to the S&P, whatever it was, the greed on those call options were incredible. Yeah, breakout failure, retest, absolutely.
What I'm drawing here are patterns. They're not all V's, but these type of patterns are one in which are excellent for credit spreads.
Yep.
This was a retest with a gap reversal, where the momentum was slowing down, the distance between the highs. So looking for, premium up here. This was a retest pattern. This one was a breakout failure.
Yep.
Yeah. So this one was a red bar ignored, but the bars are bigger. So all of these setups are one in which that we would look at. And the next step would be to say, hey, is there premium down here where we can sell a put spread? Or is there premium up here where we could sell a call spread? So it's a really simple, process, but you have to know the patterns, and you have to know, the option strategy and how to put it all together. But, just V patterns in reality are really great for this type of, for credit spreads. Would it be better to manage spreads by calculating it daily as if we're just opening it and using calculated projected break even given at that time?
Well, let me just interrupt right there. As soon as you put on a trade, you're not break even, because you got to pay the spread. So calculating break even as soon as you enter it doesn't make sense, Walter. We only move credit spreads to break even when we have a nice unrealized open gain. Like, generally 50%, I like to move at break even. And break even on a short credit spread is, if I sold it for 75 cents, well, my debit to close will be 75 cents. And then it's break even less commissions.
So Don asked a discussion of bull and bear flags and a stair-step pattern that can keep you in a winning trade. Well, I thought maybe this would have it, but it's probably easier for me to just draw out and explain the psychology of a flag pattern. So a flag pattern is one in which it creates a flagpole. And what's a flagpole? Well, it's either a wide range bar or a couple of wide range bars that create a price void above, meaning the buying was so strong that it went right up, right? The pole.
Well, Greg, show them on November 15. And then draw them your flags as, because there's your flag pole.
This,
Right.
yeah. So a textbook type of a flag is one in which, what does a flag do? Kind of flips around in the wind a little bit. And so what it does something like this. And so the idea behind that is there's no support underneath. A flag pattern creates support. And so as it comes down and maybe it pivots, right? We define a pivot as a bar with 3 higher lows to the left and right. And then it comes up and it makes a lower high and it comes down to this support that was created and buyers show up again. And so this flagging type of situation is one in which it creates an area of support where there was none. And then it eventually, takes out a high. So this is not a flag per se, because, it dipped down and it just ripped right back up again. But if it was to have, done something like that, obviously that's what we would be looking for with a flag type of a pattern.
Detective, everything we do is technical based. So even core trades would be based on managing, pivots off the weekly chart with a monthly price void until we hit our destination. But we're 100% technical traders. People love obviously Microsoft, Apple, NVIDIA. If they say if it cracks the support on my time frame just because they have good fundamentals, then I'm out of there. I'm out. So fundamentals do nothing to keep me in a trade longer. No, Bijan, I personally don't like the way longer term options move. So if you think something has potential to be in it for a year, that's totally fine. I prefer maximum 90 days and then doing diagonals against them when momentum slows. And then at the end of the 90 days, you can just roll it. So you've lost nothing, but I like the way they move better. I don't like leaps myself.
I just drew out the concept of a flag here on the 5-minute chart of Apple. So while it doesn't look exactly the explanation of a flag, the concept is there that it went up strong and it went sideways to create a launching pad, and it went sideways and it went sideways. And things changed the next day.
Hey, what are those dots?
I have to make an adjustment in the code. Some of them are that way, to bring it back down to the top of the bars and the bottom of the bars.
Oh,
There's an adjustment in the code that some of them are fixed and some of them aren't. Not a big deal. All right. Question. Since we seem to be in a stock market bubble with things like crypto, stocks that have no profitable model are still being traded in atmospheric levels, do you think fundamentals will be important in 2022? Well, fundamentals will be important to whoever looks at them. So from a fundamental point of view, the only thing we look at from a long-term perspective is yield curves, which is the distance between short-term rates, intermediate-term rates, and short-term and intermediate-term rates to long-term rates. From a fundamental point of view, we look at that in combination with indices and stocks like transports, industrial metals, and that's part of what we call techno-fundamentals. So PE ratios, sales to cash, that kind of stuff. You've always got analysts looking at that. You've got people saying this is overvalued and it becomes more overvalued, or this is undervalued and it becomes more undervalued. So those type of things are always looked at. Are they meaningful? Well, to whoever's looking at it, but how do they explain how something undervalued keeps going down and vice versa? However, when we look at yield curves, and we know that historically it's the only thing that has predictive value for a recession, and in a recession, stocks go down. So interest rates are a big part of what we look at from a longer term perspective. The pricing of industrial metals like copper and aluminum and steel, in addition to stocks that move information and services like FedEx, rails, truckers. Those are the kind of fundamentals that we look at because, in a sense, they're all knowing. If people are, drawing back from expansion, interest rates keep going down, yield curves contract. FedEx is not going to be moving goods and services. People aren't going to be paying expedited premiums to do that quickly. So that's how we look at fundamentals as it relates to the stock market. And C. Davidson on YouTube says, to take a potential multi-day swing trade on a setup, is it best to take it at the end of the day, last hour or so, entry or place a buy stop order for the next day? So David C. Davidson, the answer to that is whether you have, first of all, it's best to wait into the last hour of the day, because something that could have triggered a buy at 10 o'clock may be a terrible setup at 3:30. So yes, wait till the end of the day. Now, if you have a setup at the end of the day, part of our method says it needs to trade above a prior bar's high to trigger. So first you need to define what a setup is. And then at that point, you can say, like this is a setup here. At the end of the day here, you might say, could I buy that? Well, you could. It closed above a prior red bar and it's at support. You could buy that, but the way we would do it would be to buy a smaller position with a larger stop. The other way would be, yes, I'm going to wait till tomorrow, and then when it trades above that bar's high, I'm in. So it first comes with defining what a setup is. And our concept of bar by bar analysis, aligned with support, resistance, up, down, or sideways, just opens up you to all possibilities as to what a setup is. Or so this pullback to a rising 20 is a setup. We would not have liked the way it came down, but the trend is up. And that is, you have to say the trend is more powerful than one bar. And it, was at some support. And so it's not the best of the best setups. I think seasonality came into play here. Narrow range bar after a big wide range bar. So it would be one in which I definitely need for it to trade above a prior bar's high. And it's definitely going to be one where I'm not putting the stop under the prior bar's low with a setup like that. It's going to be further down, like somewhere around here. You just give it extra room. Trip, I was saying thank you for that answer. It was about the fundamentals as it relates to the stocks. And any other questions, Dan? Detective is saying, do you remember having different accounts to segregate trade types? If you're asking me, I never did that. I mean, we talked about it, but I have no problem with swing trades in the same account as day trades, with futures trades, with options trades. Makes no difference to me.
Exactly. And if you had an IRA account, then it's coded and set up differently. So that's probably a separate account on its own anyway.
Yeah.
And then finally, it just depends if mentally you can handle it, because the only downside is you see the market selling off a little bit, and then you might say, oh no, well, I got to get out of my Apple core long, when there's nothing wrong with it whatsoever. So it's more of a practical account setup, coding, and also your mental ability.
Um, oh, fat finger, fat finger in I guess you pressed a few keys that you didn't need to, fat finger, in YouTube saying, could you explain on industrial metals? So industrial metals like copper that's used in many products, things that get made and used to build things. If the economy is doing fantastic, historically, the price of copper goes up. So the price of copper is flat. At least it's not going down, but it was doing much better, back here, right after the Corona thing. It's like, hey, this whole thing with the coronavirus was a big, how do I say it nicely, Dan? Scam, where it was a crash and all of a sudden everything just went straight up. And it's like, whatever the threat was, we're all going to die. Clearly, there was information out there to suggest otherwise because it was just buy, right? And so everything just moved up the way it did. And now currently we have copper that's just flat here and we're waiting. Will it break out? Will the economy actually pick up? Will this hold thing with supply demand of goods that are sitting out there, in tankers? Are they, is the administration ever going to release things? These people are evil, right? They're evil son of a bitches. So as we get closer to the midterm elections, maybe their timing of this is, hey, let's just release everything so the economy is doing fantastic so that at election time, you're happy. We saved the day. But meanwhile, by the time you're so happy and, you're enjoying whatever it is, you've forgotten the pain that these SOBs put us through, and you'll go vote for them. Well, just remember what's been going on. And this was manipulated by shutting down oil and tankers sitting out there. So enough said. Anyway, looking at the charts, copper breaks out. That's a good thing. Steel, which has been trending down. Oh, maybe people are using more plastic than steel, but it was doing real well over here, and here it's not doing so well. Aluminum. Why does aluminum keep going up? Which looks like it'll go higher. So not everything is in lockstep. And then, looking at interest rates, they're perking up here a bit today, but, they went through this decline. So it's a combination of this information that helps guide. However, when we start looking at the direction of interest rates, and you can see where the, this should be 1.2, and you look at the 10-year, you can see it's not too far away. And so if that lower one, the 5-year, gets above this one, that's inversion. That's going to be a problem. This is something that we keep an eye on, and it moves very slow. But I can show you times where you look at that and you say, wow, that is like a holy grail of indicators, how accurately it gave you a heads up of what was coming. So it's something that should definitely be looked at. Veteran thing. So you view it more like how you would the transports, as opposed to you might, right, look gold on inflation, which gold and inflation has taken a bit of a disconnect as to what's happening with Bitcoin. People say Bitcoin is the new inflation hedge. I don't know. But yeah, gold. But looking at all of these things, gold, metals, industrial metals, transports, yield curves, these are all the tools of a long-term investor. In addition, we're looking at different sectors. How well are semiconductors doing? How well is oil doing? And so on. So where's money flowing into and out of? Any other questions there, Dan? Dan looks like he's frozen.
No, I'm here. I was reading. Ben has one here for you.
We're talking about economy downturn in the near future. Do you have any comments and recommendations on that? Well, you know, what I've been talking about relates to that. So look, as self-directed investors and traders, we have our own tools to guide us. So when you say everyone is talking about something, well, are they right or are they wrong? Well, if they're saying the economy is there's going to be a downturn, you're going to see the transports start to deteriorate. They're not. I would say they're more neutral. They're not deteriorating. You're going to see the yield curve begin to narrow. And while they've narrowed some, they're still historically far enough apart where a recession is not a concern. Now, as this information changes, it's just readily available for us to just look at. So I don't have to read Barron's. I don't have to go to some website. I don't have to, you know, look at any of these guru things that someone else is there to predict what's happening. And so, you know, I did that decades ago, searching for the information, you know, looking at things like what newsletter writers are doing. Are they bullish? Are they bearish? So many different pieces of information. And it boils down to a few simple things that are available to all of us. Right. So we're not here saying, hey, you got to pay us to tell you, you know, about yield curves and transportation. We'll teach you how to look at all of that and put it all together. But it's information that's available to you. And it's like, if you see transports going down and you see a yield curve inversion, which is what happened before the huge bear market that came in March of 2000, the yield curve was inverted, the transports were going down, and all the warning signs were there that hell was coming. And it sure as hell did, you know. And you think this is a bull market? But look, back in the late 90s, that was a bull market. I think while even prices are higher now, the way things went up then, my perspective and memory was a lot better and more powerful than what it is now. There was a lot more certainty about the way things went up. And the way things went down after they started going down after March of 2000, the NASDAQ went down 95%. So nobody has seen anything like that in recent years. So financials haven't been doing well. Trevor's asking about American Express. Financials haven't been doing very well. You know, this broke out, it failed, a momentum moved down, and it's just kind of sitting there. I don't know if it's repairing the damage or it's getting ready for the next leg down. Look, clearly you've got, you know, a breakdown, you got a lower high, but now it's made a higher low. And I don't know whether this is a lower high at this point or whether it's going up here. I look at something like this and it's like, hey, could be good for an iron condor. You know, if there was premium up here and down here to do credit spreads, but directionally, it's a stay away from. It's not going anywhere. And AMAT broke out. You know, they underperformed for a very long time. Now it was in a trading range. It broke out, it pulled back, buyers stepped up. It's at new all-time highs. Looks like it's going higher. Right? I mean, there's nothing else to take away from it. And then you say, well, it's up a lot, big deal. Unless it comes all the way back down here, I assume it's going to go up. T Brownie, thank you for translating because I can't read Spanish. I really know you for trading ideas, and the truth is that even if I don't know much English. You seem like geniuses with experience. That was a perfect analysis, Brownie, because we are geniuses with experience. It's a lot of experience, a lot of mistakes, school of hard knocks, as they say. It isn't easy. And that's why education is what accelerates anyone's learning curve, no matter what it is that you want to learn. And after education comes experience. Just because you take a course, that doesn't mean that you're proficient at what you learned. Look, I used to be an auto mechanic in another lifetime, right? So it's like, okay, here comes a car, I got to take the engine out of it. Well, the thing I do is I take the hood off, and then I unbolt the motor mounts, and I take all the wires off, and it's the whole big process. And when I'm done disconnecting things, the engine comes out. Done deal. Do what you got to do with it. In the stock market, you go through that process of these nuts and bolts, and all of a sudden, some Fed news comes out or coronavirus hits, and it's like, holy shit, what now? Oh, the engine just fell on the floor. So look, the stock market is a different beast with different influences, and you have to learn how to roll with those things. And brings us back to that money management thing, that there's no guarantees with this. It's not that situation where, you do this, this, and this, and it results in this outcome. We're odds players. And so as we play those odds and look at those things, say this is an acceptable setup and risk, and we put so much money into it, and see what happens next. Then we have strategies to monitor what's happening. We're not left out in the cold as to hope mode. There's no hope mode here. In part, there's some, but All right, last question. Turdy saying, Wolf at the point, October gap week time frame, breakout failure, buyable. F. So I had to compress to the weekly time frame after looking at the daily, Tim, see if it made sense. And it makes sense in that it moved up. I don't like the level of retracement, but it's beginning to repair the damage of that retracement. And so now what I would like here is a retest of the low and a flip back up based on the higher time frame. It'll be a buy, it'll be a put spread, and it'll be a directional buy based on this weekly time frame. It's not green, it's greeny, Don. Greeny. If you're talking about the 50%, if you're talking about the green room, right? Green, I think it's greeny. I don't think it's greenies to purchase the green room. Let me just hold on a second. We did have some kind of maintenance done on the website last night, which scared the hell out of me, because the whole thing went down in the middle of the night, but everything's back and running. And so that, which is so look, it's Christmas time. I see what you're saying, Don. I'm not sure about green. So green is, look, if you're a member of Master Trader in some way, we discount the room. And so the chat room. Green is for somebody that comes and says, hey, I like you guys, but I don't give a damn about your letters. I don't want this or that. I just want access to your room. I was like, okay, fine. You could join the room, and it's still a hell of a deal. And so there's that coupon code green, which is for annual, but just use the middle one. All right, it's holiday time. Use the middle one. The coupon code is greeny. And look, $48 a month for the chat room at holiday time, that deal, because break it down, that $558, $84 to $48 a month. And you calculate that, knock that down to how much that room costs you a day to access to education and trades. It's a no-brainer, as we say. So I expect everyone to be joined up for the green room. We'll see you in there tomorrow. And we'll be back next year. All right, all the best.
Happy New Year, everyone.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.